dear students, to the massive open online course on money and financial markets. In today's module, we are going to learn about financial assets and its economic functions. The main objective of this module are as follows. We are going to delve deeply into what financial assets are all about, what are their properties, and what is their principal economic function or role in the economy. We would also deal with the distinction between financial assets and tangible assets, and also between debt and equity instruments. Somewhere within the module, we are also going to deal with how financial assets are priced. Now, coming to the concept of the market economy, we find that the allocation of economic resources is the outcome of various private decisions. Prices are the signals operating in a market economy that direct economic resources to their best use. If we look at the various types of markets that we can see in an economy, we can broadly divide them into two types. Number one, the market for products, which is goods and services, and which we essentially called the product market. And also, we have markets for the factors of production like labor, capital, land, and so on, which we call the factor market. In the context of financial assets, we find that we are interested in only a part of the factor market. That is, the market for financial assets, which we simply call the financial market. So, when we talk only about assets, how do we define it? An asset is, basically speaking, a possession, any possession that has value in exchange. So whenever we try to exchange these commodities or services or anything, in return, we are going to get some value for it. And assets can also be classified into tangible assets or intangible assets. Now, what is a tangible asset? A tangible asset is one whose value depends on certain particular physical properties. For example, let's look at the buildings, lands, factory, machinery. We can call all these things as tangible assets. What are intangible assets? They basically represent the legal claims to some future benefit. Their value has no relation to the form, physical or otherwise, in which these claims are recorded. So we come to the basic question now. Since we now know the two different types of assets, the tangible and the intangible assets, now we need to understand what are financial assets. Are they tangible or intangible assets? Basically, financial assets are intangible assets. The typical benefit or value of such assets basically is a claim to future cash. Now, when we talk about financial assets, we also need to understand who is the issuer of this asset and who holds these assets. The entity that has agreed to make future cash payments, they are called the issuer of these financial assets, while the owner of the financial asset is called the investor of these assets. We need to understand various examples to get deeper into the concept. Now, let us take a loan that is given by the Axis Bank to an individual to purchase a car. In this context, the Axis Bank is the investor, while the individual is the borrower. The terms of the car loan establish that the borrower must make specific payments to the commercial bank over time. the cash flow for this asset is made up of the specified payments that the borrower must make. Similarly, we take another very important example. Suppose a bond that has been issued by the government of India. In this case, who is the issuer? Obviously, the government of India is the issuer because it agrees to pay the holder or the investor the bond interest payment every 6 months until the bond matures. And then on the date of the maturing of the bond, the whole amount is repaid back. The whole amount that was borrowed is repaid back. If we take the case of a bond which is issued by any other state, not by the central government of India, but by any other state, say the state of Maharashtra, the same explanation holds. We can also take the example of a share of common stock that is issued by Infosys. Now, Infosys is an Indian company which has shares, and say suppose we buy it, so it would be part of our financial asset. But how can we say that? Because it entitles the investor to receive the dividends which are distributed by the company. The investor in this case also has a claim to a pro rata share of the net asset value of the company in the case if Infosys company suppose turns out to liquidate itself. We also know that there are many investors who buy shares of foreign companies. Like suppose a share of common stock issued by the Honda Motor Company. It is a Japanese company. Will it be considered as financial asset? Of course, it will also be considered as a financial asset because the same explanation as that of Infosys will also hold in the present case. So, after understanding the various examples of financial assets, we now try to understand the difference between debt and equity instruments. In the case of financial assets, the main types of financial assets are debt instruments and equity instruments. The claim that the holder of a financial asset has maybe either a fixed or a varying amount or residual amount. So in the former case, the financial asset in that case is going to be referred to as debt instrument. For example, the car loan that was taken from the Axis Bank, it is a debt instrument. The Government of India bond, it is a debt instrument. The State of Maharashtra bond, it is a debt instrument. So all these examples which I had cited in the previous slide are all examples of debt instruments because they require fixed payments. If we look at equity instruments, they are also called residual claims because they obligates the issuer of the financial asset to pay the holder an amount based on earnings, if any, after the holders of the debt instruments has been paid off. So examples of such type of equity instruments are obviously the common stocks in the market, the partnership share in business. These are all types of equity instruments. Now, if you think that we can categorize all type of instruments into either debt or equity, we are totally wrong. Because there are certain securities which can fall in both the categories. Like there's a concept called preferred stock. What is preferred stock? Preferred stock is an equity instrument that entitles the investor to receive a fixed rupee amount. Okay? This payment is contingent, however, and due only after payments to debt instrument holders are made. And also, there is a combination instrument which is available, which are called convertible bonds. These convertible bonds allows the investors to convert debt into equity under certain circumstances. So, you see, we can have instruments which neither fall into the debt category nor into the equity category. So, both debt and preferred stock that pay fixed amounts, they are called fixed income instruments. Again, if we delve further into the into the debt and equity instruments, we tend to get certain differences and similarities between them. If we look at the similarities, we can see that both the securities are issued at face value and they also trade at market value, which may be higher or lower than the face value. So this is a basic similarity between them. But if we take to look at the differences, there are certain differences between these two securities. Number one, equity securities indicate ownership in the company. So whenever you own equity securities, you own common stocks shares, you are basically an owner of the company. Whereas debt securities indicate that you are taking a loan from that company. In very simple words, equity securities generally do not have a maturity date, whereas debt securities typically has a maturity date. Equity securities have variable returns in the form of dividends and capital gains, whereas debt securities have predefined return in the form of interest payments. Equity shareholders are entitled to voting rights because they are the owners of the company, so they do have voting rights. Since debt instruments or debt securities is only a loan from the company, it does not indicate ownership, so the holders of debt securities do not hold any voting rights. We would now explore the various properties of financial assets, because a person, before he tries to hold financial assets, he would like to have a look at these properties. First one is moneyness. We know that some financial assets are used as a medium of exchange or in the settlement of transactions. These assets are called money. There are also some near money which can be transformed into money at little cost, delay, or risk. So any person who wants to own a financial asset would invariably like to have the moneyness component part of it. The second point is divisibility and denomination. This relates to the minimum size in which a financial asset can be liquidated and exchanged for money. It is desirable from the point of view of investors, but not from the point of view of the borrowers. Third point is reversibility. It is also called the turnaround cost. It is basically the cost of investing in a financial asset and then getting out of it and back into cash again, like deposits in a bank. So people would like the reversibility component too. The fourth point is cash flow. The return that an investor will realize by holding a financial asset, and obviously the investor would want to have a larger cash flow. Fifth point is term to maturity. The length of the period until the date at which the instrument is scheduled to make its final payment. This is a very, very important point. That is a period part of it. An important property of financial asset is also its convertibility. It is important that assets can be made convertible from one class to another class, or they can also take the conversion in the same class itself. Like a bond can be converted into another bond, or it can span classes. Currency is also a very important component of financial assets. Very important property rather. Since the global financial system is increasingly integrated, and in the light of freely floating and often volatile exchange rates among the major currencies, it becomes important to know the currency in which the financial asset will make cash flow payments. So basically, it is very important that cash flow payments are made in the form of strong and major currencies like dollar, yen, and so on. Liquidity. How much sellers stand to lose if they wish to sell immediately, as against engaging in a costly and time-consuming search. So liquidity is a very, very important property for financial assets. Another important property is return predictability. It is a basic property of financial assets in that it is a major determinant of their value. Complexity. Some financial assets are complex in the sense that they're actually a combination of two or more simpler assets. So the less complicated they are, the less complex they are, the more desirable will they be in the form of financial assets. And the last point is tax status. Government regulations for taxing the income from the ownership or sale of financial assets vary widely or sometimes wildly. So it is also very important to understand under which tax bracket that particular financial asset falls into so that an investor can decide whether he will take that asset or not. We now try to focus on the expected return of financial asset. Now, given the expected cash flow of a financial asset and its price, we determine its expected rate of return. For example, if the price of a financial asset is 100 rupees and its only cash flow is 105 rupees 1 year from now, then its expected return would be around 5%. The next important thing that we will try to ponder on is how do we price a financial asset? Now, price of a financial asset is basically equal to the present value of its expected cash flow, even if the cash flow is not known with certainty. Now, if a Government of India bond promises to pay 3,000 rupees every 6 months for the next 30 years and 10 lakh rupees at the end of 30 years, then this is its cash flow. Now, if you remember the example that we took in one of the slides, that is car loan from the Axis Bank. In the case of that car loan, if the borrower is obligated to pay 5,000 rupees every month for 3 years, then this is the cash flow of the loan. So this is mainly the concept of cash flow which I explained just now. So the correct price for a financial asset will be expressed as a formula. So price is basically equal to current cash flow in period 1 divided by 1 plus R. Here R denotes the appropriate discount rate plus cash flow in the year 2 divided by 1 plus R square plus ... plus cash flow in the year n divided by 1 plus R to the power n. So here P is the price of the financial asset. CFT here denotes the cash flow in year T. T is basically from 1 to n. N is the maturity year of the financial asset and R is the appropriate discount rate. Now I think all the terms here is understandable. You can just put the figures here and get the price of the asset. But what is most important here is to understand what do we essentially mean by the discount rate. What is R? Now, appropriate discount rate R is basically the return that the market or the consensus of the investors they require on the asset. So R basically is a consolidated amount of the real rate of interest RR plus the inflation premium that is IP plus the default risk premium that is DP plus the maturity premium that is MP plus the liquidity premium that is LP and EP that is the exchange rate risk premium. All this accounted for gives us the discount rate which will be accounted for in the price of the financial asset. So obviously the next question that I feel the students are having in their mind is then what is the difference between a financial asset and a tangible asset? Is there no difference between them? Because both are expected to generate future cash flow for their owners. Let us take the example of Air India. Suppose Air India purchases a fleet of aircraft. The airline would expect to realize the cash flow from passenger travel. So here we find that financial asset and tangible asset, they're basically linked to each other because ownership of the tangible assets is financed by the issuance of some type of financial asset. For example, suppose that a debt instrument is issued to raise the money to purchase the fleet of aircraft. The cash flow from the passenger travel will be used to service the payments on the debt instrument. Thus, ultimately, the cash flow for a financial asset is generated by some tangible asset. That is why I said that financial asset and tangible asset, they're basically linked in nature. Finally, we come to the role of financial assets in an economy. The financial asset basically provides two very important economic functions. Number one, they allow the transfer of funds from those entities who have surplus funds to invest to those who need funds to invest in tangible assets. So there is a diversion of funds from those who have surplus funds to those who are deficit in funds, but they need to invest to buy tangible assets. And second, they redistribute the unavoidable risk related to cash generation among the deficit and surplus economic units. The claims that are held by the final wealth holders generally differ from the liabilities issued by those entities who demand those funds. The role is performed by specific entities operating in the financial system, and they are called financial intermediaries. The latter ones transform the final liabilities into different financial assets, which are generally preferred by the public. Now, to explain this function of the financial assets, I will take three examples, and please listen to it very carefully. Suppose there's a person, Mr. A. He has obtained a license to manufacture Chhota Bheem wristwatches, that is Chhota Bheem embedded wristwatches for kids. And he needs, say, suppose 10 lakh rupees to purchase the plants and equipments to manufacture the watches. But unfortunately, he has only 20 lakhs in his savings account. And he does not really want to invest it because it is part of his life savings. Then there is another Mr. B who has recently inherited around 7.30 lakh rupees. He plans to invest 30,000 rupees for a small vacation, and he wants to invest the remaining 7 lakh rupees. And there is another person, Mr. C, who is an upcoming attorney with a very prestigious Mumbai firm. And he has received a bonus check, and after net of taxes, he has around 2.50 lakh rupees in his hand. Out of that, he wants to buy a diamond ring for his wife for around 50,000 rupees, and he will have 2 lakh rupees left in his hand. Now, all these three individuals, A, B, and C, they meet in a party. Okay, and Mr. A tells them about his plans, and both Mr. B and Mr. C has got some surplus funds. So what they do, Mr. A agrees to invest at least 1 lakh rupees of his savings into his business, and he is willing to sell a 50% interest equity instrument to Mr. B for 7 lakh rupees. Mr. C also agrees to lend Mr. A 2 lakh rupees for 4 years at an 18% rate of interest annually. So now what we find? We find Mr. A will be responsible for operating the business without the assistance of Mr. B and Mr. C. But Mr. A now has got 10 lakh rupees to manufacture the watches, to build his dream manufacturing plant of Chhota Bheem wrist watches. So what are the outcome of this meeting? We find that two financial claims has come out of this meeting. Number one, it is an equity instrument which is issued by Mr. A and purchased by Mr. B for 7 lakh rupees. And number two is a debt instrument which is issued by Mr. A and purchased by Mr. C for 2 lakh rupees. So thus, the two financial instruments or assets has allowed the funds to be transferred from B and C, who had surplus funds to invest, to Mr. A, who had deficit in funds, who basically needed funds to invest in his company. So we find the first function of financial assets to be satisfied in this case. But we also had a second function of financial asset, that is redistribution of risk. How is this done? Mr. A was not willing to invest his life savings of 2 lakh rupees. This means that he wanted to transfer a part of that risk. So what did he do? He does that by selling Mr. B a financial asset that gives him a financial claim equal to 1/2 of the cash flow from the business. He further secures an additional amount of capital from Mr. C, who is not willing to share in the risk of the business except for the credit risk in the form of an obligation requiring payment of a fixed cash flow regardless of the outcome of the venture. So we find that total shifting of risk has also taken place. Mr. A did not have to invest his full money that he had in his business. His risk has been shared equally by Mr. B, while Mr. C gives him some fund but does not take any share of the risk. So this is how financial asset performs its economic role in the economy, its major role in the economy. So, but at the end of this module, I hope you have understood how a financial asset is priced, what role the financial asset plays in an economy, and obviously the understanding of different concepts like debt and equity instruments, tangible and intangible assets are also done. Thank you.